Tim, we're at the start of the 3Q earnings season, which could prove pivotal considering the multitude of issues that are affecting corporates specifically just now and risk assets a little bit more broadly. So if we start with the elephant in the room, how important is China to Europe's earnings?
It looms large. In fact, if you look at 80-odd companies that have got substantive exposure to China by our calculations, that averages about 20% revenue for these companies, and it aggregates up to about $450 billion in total. So if you think about that, what are the key sectors? Autos clearly come to mind. You think about Volkswagen and Mercedes and BMW. They all have about 20+% of revenue, but more than 30% of their profits are from China. Luxury goods. We know that the Chinese are buying luxury goods historically, especially when they travel. And we see what the ramifications are when it disappoints. Look at LVMH recently. It's also big for miners. It's big for industrials. So it does loom large. And the canary in the coal mine, the early warning indicator that we're looking for are the Swedish industrials that all report over the course of the next week or two. Early in the reporting cycle, they all have exposure.
So interesting place to follow on from the canary in the coal mine. So inflation's clearly been a big theme this year, and it exerts a negative impact on the consumer. But on the other hand, in the commodities complex, it's been a really mixed picture. So what are you thinking about in terms of the impact on margins for staples and industrials for that matter?
Yeah, margins are maybe the other big hot button beyond China from our perspective this quarter. You know, if you think about those two sectors in particular of staples and industrials, they all benefited in terms of profitability with restructuring and cost cutting out of the pandemic, but they've continued to push margins through pricing power. And in fact, if you look at the European market in total, the operating margins hovering around 15-16% right now, which is almost at record levels from where it peaked in 2007. Staples and industrials are in fact at record levels by a wide margin. And the issue with pushing price at this point as economies are slowing is that you start to have an impact on volume. And whether it's the third quarter or fourth quarter or early next year, we do think that there's risk in this very high profit margin, especially for those two sectors.
And Tim, last thing, currency. Now, you know, the US dollar over the course of the year has maybe defied belief, and it's been perpetually strong despite the bearish calls out there. How do you see FX role playing into the 3Q earnings season?
Yeah, you know, it's interesting on currency, Rod. If you look at the euro and the pound and the Swiss franc, they were all relatively strong from late last year in through the summertime. And if you look at the third quarter average year on year, currency for European companies is a pretty big headwind. It could be 8, 10, even 12%. Where that's most felt quite often is in the defensive groups that don't have sort of the cyclical edge. So you think staples and pharmaceuticals. We do think that this headwind that's been developing all year long is now starting to turn with the dollar strengthening. You look at the pound; it's off 6-7% from a high. The euro is off. So, long story short, it is a negative for the third quarter, but we would expect to have possibly positive comments from managements as we look into 4Q and possibly into next year.
Tim, thanks a lot for your time and your insights. As ever, it's going to be an interesting earnings season to watch. Thank you.